Hello students, good morning and welcome to this special YouTube class on the Unacademy platform. So today we are going to have the second part of the comprehensive discussion on partnership accounts. So basically part 2. So for students who still do not know me or they are not yet introduced to me, myself is Kajal Chakravarti. I'm a Chartered Accountant and Masters of Commerce. I'm an accredited financial management specialist working in the United Nations as a consultant financial management specialist. So today our discussion is on partnership accounting. In the last session that I had on YouTube, I discussed on the partnership accounts. We had a comprehensive discussion, but that was part 1. So today is the second part of it, part 2. Okay, so this is the class structure is like this: profit sharing ratio, okay, revaluation of assets and liabilities, and accounting treatments on admission of a partner, retirement of a partner, and death of a partner. This is how we are going to discuss these problems. Second part of it, part 2. Okay, so this is the class structure is like this: profit sharing ratio, okay, revaluation of assets and liabilities, and accounting treatments on admission of a partner, retirement of a partner, and death of a partner. This is how we are going to discuss these problems. Second part. Part 2. Okay, so this is the class structure. So, profit sharing ratio, revaluation of assets and liabilities, accounting treatments on admission of a partner, retirement of a partner, and death of a partner. These are the things which we are going to cover today. Okay, so with that, let us proceed. What is the profit sharing ratio? Where is the PSR documented? Profit sharing ratio, we are going to call it as PSR. Okay, so what is the PSR? Where is the PSR documented? What happens if PSR is not documented? When does the PSR change? What happens when the PSR changes? Okay, so these are the things that you need to know about the PSR. Profit sharing ratio is the ratio in which the partners share their profits or losses. Okay, PSR, that is very simple. So where is the PSR documented? What is the PSR? I just now told you. And where is the PSR documented? The PSR is documented in the partnership deed. The PSR is documented in the partnership deed. So the partnership deed actually will tell that what is the profit sharing ratio of the partners will be. What will be the profit sharing ratio between the partners? Okay. So if the partnership deed is silent about it, okay, if it is not documented, then the profits or losses of the firms are shared equally. Why they are shared equally? Because you know that wherever the partnership deed is silent, we need to go and follow the Partnership Act. We need to go and follow the Partnership Act. Okay, and Partnership Act 1932 says that the profit shares, profit and loss shares should be equal between the partners. So if the PSR is not mentioned in the partnership deed, the profits and loss should be shared equally. So when you get a problem in your examinations or when you are solving a problem for an exercise purpose, if the profit sharing ratio is not given in the sum, then you should assume that the profit sharing ratio is equal. Okay. Do not try to calculate any ratio if the ratio is not given. Okay, don't try to calculate the ratio in the ratio of the capital or any other convenient ratios that you may think of. Do not do any such thing. If the PSR is given, it's fine. The PSR will be that only. If the PSR is not given, the PSR will be equal. The profits and losses will be shared equally. So there is no other option for that. Okay. When does the PSR change? Now the profit sharing ratio is the agreed upon ratio which the partners have decided to be continued. Okay, but this PSR can change in certain circumstances. Okay, the PSR is not something which is infallible, or it cannot change, or it's something very permanent. Nothing is permanent. Okay, so this PSR can also change, and such change will happen on admission of a new partner, on retirement or death of an existing partner, or on situation other than A or B. What is other than A or B? I'm going to tell you. Okay, so first let us see on admission of a new partner what can happen. On admission of a new partner, what can happen? And on retirement of a death of an existing partner, then also PSR can change. Okay, after that we are going to see the situation which are not included in these two. Okay, so when the PSR change in admission of a new partner, the new partner gets a share of profits. Okay, the old partners share the remaining profits. The PSR between all the partners now, including the new partner, is the new PSR. The PSR between the old partners prior to the admission of the new partner is called the old PSR. Okay, so there are three partners over here. There are three partners, say for example, there are three partners over here, A, B and C. Here is A, here is B, and where is C. Okay, so this is suppose the ratio 3:2:1. That means A is getting 3/6, B is getting 2/6, and C is getting 1/6. A is getting 3/6, B is getting 2/6, and C is getting 1/6. So this is the profit sharing ratio which has been agreed upon between the partners. Okay. Now suppose a new partner is coming in, D, a partner called D is coming in, and it is decided that he is going to get 1/4 share of profits. Suppose. Okay, so what will happen now? The profit sharing of these three partners is going to reduce, obviously, because they are going to get only 3/4 of the remaining profit. 3/4, because 1/4 will be taken away by him. So how much share will A will get? A will now get this 3/6 of 3/4. Okay, B will get 2/6 of 3/4, and C will get 1/6 of 3/4. So this is how it's going to happen. Okay, so A will get 9/24. A will get 9/24. B will get 8/24. C will get 3/24. And D will get 1/4, that is 6/24. So the ratio will now become 9:8:3:6. Wait, I think there is some mistake. It cannot be more than 24. 3, 2, 3/6, 9/24. This is 2/6, so this is 6. Oh, sorry, this is 6/24. 6/24. Sorry, 6/24. C will be 1/6 of 3/4, so that is 3/24. And okay, so yes, so this will be the ratio. 9:6:3:6. 9:6:3:6, or it will be 3:2:1:2. So this becomes a new ratio. So this is the new ratio. Okay, and this ratio was the old ratio. This is the new ratio, this is the new, and this is the old. Okay, This will be the new ratio and this will be the old ratio. So there is, I mean, nothing very complicated that which cannot be understood or has to be explained again and again. So let us proceed. Okay. So PSR change on admission of a new partner will continue. The sacrifice ratio in which the old partners forego a share of their profits on admission of a new partner. Okay. When a new partner comes, so naturally we saw, we saw over here, for example, we saw that A was getting how much share? A was getting 3/4 of 3/6 of share. A was getting 3/6 of share. So now A is getting how much of share? A is getting 3/8. Previously A was getting we saw that A for example, for A was getting here how much? 3/6 of share. And now we find that A will get, 3/8 of share. So this is the sacrifice. This was 50% and this is much lesser than that. This will be about 37.5% or something like that. So basically the ratio that he is actually sacrificing 3/6 by 3/8. Okay, so this is basically this will be 48, so 24, and then this is 18, so 6 by 48 over here. And similarly B is also sacrificing. B was getting how much? B was getting 2/6, and now B is getting actually how much? 2/8. So 2/6 minus 2/6 minus 2/8, so that is 16 minus 12 upon 48, so it is 4 by 48, or the ratio is then 6:4. Okay, or we can say it is 3:2. So this is the sacrifice they are making. So the sacrifice is nothing but the ratio in which the old partners forego a share of their profits, because when the new partners come, naturally a part of the share of the profit is gone, because that will be enjoyed by the new partner. Okay, so the ratio in which these partners, the existing partners, forego their share of profits is called the sacrifice ratio. A and B, we'll see over here. A and B are partners and the PSR is 5:3. C is admitted with 1/4 share. Calculate the new PSR and sacrifice ratio. So here share of new partner is 1/4. So remaining share will be 1 minus 1/4, 3/4. Share of A is 5/8 of 3/4, which is 15 by 32. Share of B will be 3/8 of 3/4, which is 9 by 32. And share of C will be 1/4. It is already decided, which is 8 by 32. So naturally we need to make an LCM and make the denominators all the same so that you can compare. So the ratio becomes 15:9:8. The ratio becomes 15:9:8. So this is the new PSR. This is the new PSR. This is the new PSR. And now we are going to see what is the sacrifice ratio. A sacrifice will be 5/8 by 15 by 32. Now A is now getting 15 by 32. A originally was getting how much? Originally A was getting 5/8. So sacrifice ratio is 5:3. A is now getting 5/8. And B is now getting 3/8. A was originally getting 15 by, A is now getting 15 by 32. Originally he was getting 5/8. B is originally is now getting 9/32, and his original original share was 3/8. So if you make the calculations, you come in the ratio of 5:3. Okay, so the sacrifice ratio becomes 5:3. The sacrifice ratio becomes 5:3. So original ratio was 5:3, and sacrifice ratio is also 5:3. You can see. Okay. So when is sacrifice ratio is equal to old ratio? You just now saw that the sacrifice ratio is equal to old ratio. You just now saw here the original ratio was 5:3, and now we also calculated the sacrifice ratio, which is also 5:3. So therefore we saw that the sacrifice ratio is same as the old ratio. When the internal ratio between the old partners do not change, the sacrifice ratio is same as old ratio. Okay, so my advice to you is that when you have a problem on admission of a partner, just see whether the new partner, whether the internal ratio between the partners is changing or not. If the internal ratio between the partner is not changing, or the problem is silent about it, that means the internal ratio between the partner is not changing. Okay, so for example, I'll tell you, there's a situation like this. They are saying, for example, A and B. Okay, so say A and B, and their ratio is, for example, their ratio is say 4:1, 4:3, suppose 4:3. Okay, and then a C is coming, and he is offered us say 1/10 of the share, 1/10 of share. Okay, so if this much of information is given in the sum, that means the sharing will be like this. Okay, so C will get 1/10, and A and B together will have now 9/10, because 1/10 is gone to him together, and then A will have 4/7 of 9/10, and B will have 3/7 of 9/10. Why they are going to have this? Because internally between themselves the ratio is not changing, and when the ratio in between the partners internally is not changing after the admission of a new partner, when the ratio between the old partners is not changing within themselves, and internally there is no change in the sharing between the old partners even after the admission, then sacrifice ratio is always equal to the old ratio. So do not try to calculate sacrifice ratio unnecessarily. The old ratio will be the sacrifice ratio. The old ratio will always be given to you. Okay, so therefore you do not waste any time in calculating sacrifice ratio. Sacrifice ratio is required to be calculated for goodwill adjustments, okay, and for other reasons also. We'll see that. But my advice to you is that if there is no change in the internal ratio between the partners, then sacrifice ratio will always be equal to old ratio. Do not waste your time in calculating it. Having said that, when the internal ratio of the old partners change, in this case sacrifice ratio is different from the old ratio. Okay, we'll see. A and B are partners with PSR of 3:2. They admit C, and the new PSR is decided to be 5:3. So you see. So originally it was 3:2. Originally it was 3:2, and now original and new is, you see, it has changed as 5:3. This has changed. So this has changed, means sacrifice ratio will be different from the old ratio. It cannot be the same as the old ratio, and then you have to calculate. So now we will calculate. A's old share is 3/5. A's new share is 5/10. A's sacrifice will be 3/5 minus 5/10, which is 1/10. B's old share is 2/5. Okay, B's old share is 2/5. You can see, and now B's new share is 3/10. Right? So therefore, B's sacrifice is 4/10 minus 3/10. Okay. 2/5 means 4/10, so 4/10 minus 3/10 is 1/10. So sacrifice ratio is 1:1, and this is different. This is different from old ratio. This is different from old ratio because internally the ratios have changed. So that is the thing we need to know. So when the partners, when one of the partners retire or dies accidentally, then the concept of benefit ratio comes up, because now the profit will be shared by less number of persons than it used to be, obviously, because one partner is gone. So the profit sharing will now be between now be done between the existing partners. Okay, because the retired or new partner share is enjoyed by the existing partners. The ratio in which the existing partners gain on retirement or death is the benefit ratio, and benefit ratio is new share minus old share. Okay, new share minus old share. Okay, example, A, B and C are partners with PSR of 5:3:2. B retires and the new PSR between A and C is 3:2. 3:2. So calculate the benefit ratio. So here it is, A's new share is 3/5, A's old share is 5/10. A's new share is 3/5 here, because it is 3:2 now. Okay, and his old share was 5/10. Old share was 5/10. So A's benefit is 3/5 minus 5/10. Okay, or 1/10. And C's old share was how much? Old share was 2/10, and now his old share is becoming 2/5. Okay, so double actually it has become. So 2/5 minus 2/10, so he is getting 4 minus 2/10, so it is 2/10. Therefore benefit ratio is 1:2. Benefit ratio is 1:2. Remember, benefit ratio is equal to old ratio if the internal ratio between the existing partners do not change, just the same as sacrifice ratio. If the internal ratio between the existing partners do not change after the retirement or death of a partner, then there is no impact. There is no different impact as far as the sacrifice benefit ratio is concerned, because benefit ratio will be always equal to old ratio, and don't try to calculate it unnecessarily and waste your time. Main thing is for both for admission of a partner and the existing retirement of or death of a partner. For admission of a partner, just see that if the internal ratio between the old partners change or not. If it doesn't change, forget it. Don't have to do anything. The old partners, the old ratio will be always equal to sacrifice ratio. For retirement or death, see whether the internal ratio between the continuing partners, the existing partners, change or not. If it doesn't change, then benefit ratio will be same as old ratio. But there is a need for calculation of benefit ratio. There is a need for calculation of sacrifice ratio. What is that we are going to show? But you must remember that both benefit ratio in the case of retirement or death and sacrifice ratio in the case of admission of a new partner will be unchanged from the old ratio if there is no change in the internal ratio between the existing partners in case of an admission, or the old partners in case of a existing partner in case of a retirement or death, or the old partners in case of a new in case of an admission of a new partner. Okay, so this is what I want you to remember, and henceforth do not waste any time in calculating benefit ratio or sacrifice ratio when it is really not required. That is when the internal ratios between the partners do not change in either of the situations. So admission of a partner, what are the accounting implications? Now we are going to discuss about admission of a partner. Okay, so what is the goodwill adjustments and is the revaluation, then adjustment for existing reserves and losses, and adjustment of capital according to the PSR. Okay, so this is an optional thing. Rest are all compulsory, and this is an option which can be decided by the partners. It depends on the whims of the partners, depends on the decision about the partners. Okay, so what is that we are going to come, but first let us see the other things. Let us see the other things. So one is goodwill adjustment, one is revaluation, one is adjustment for existing reserves and losses, and adjustment of capital according to the PSR. Goodwill adjustment. So we saw that what is goodwill in the previous class. We saw what is goodwill and how is goodwill valued. Okay, And what is the importance of goodwill? We know that goodwill is a reputation which is enjoyed by a particular firm compared to other firms, and there are various methods of evaluation of goodwill. So goodwill becomes an important aspect, important factor in the case of an admission of a partner or even retirement or death of a partner. Okay. In case of an admission of a partner, since the new partner is coming in, he has to pay that extra premium because he is joining this particular firm, which is going to give him more profits, which is more reputable. So naturally, he has to pay some money in excess from the capital, over and above his capital. So for that, certain accounting entries will be necessary, and we are going to see that. Okay. So one is goodwill adjustment or admission of new partner will consider goodwill value is determined and new partner's share of goodwill is determined. First, these two things. First, you calculate the goodwill value. So, say for example, A, B, and C are partners. So A, B, A and B are partners. Okay, A and B are partners. Okay, and they are having a ratio of 3:2. And now they admit C for 1/4 of share. 1/4 of share. Okay, so the goodwill is valued. They value the goodwill under super profits method and the average profits method or under the capitalization method. Okay, that is value of business method. These are the three methods. So under whatever method they have valued the goodwill as say 1 lakh rupees. Okay, so what is the share of the goodwill of C? 1 lakh is the value of the total goodwill. So 1/4 of this is C's goodwill, which is 25,000. This 25,000 rupees is the value of the goodwill of the new partner. This is the value that he has to bear. This is the burden that he has to bear because he is joining this firm. He has been given opportunity to join this reputed firm. Okay, so that is why he has to pay this excess amount. Okay, so 25,000. So first is the goodwill value is determined. Okay, by applying any method, and then the new partner's share of goodwill is determined. You know what is his share, so you can easily calculate that. So what is the next step? The next step is that this new partner's goodwill share, there are options. One is the new partner brings cash for goodwill, and the other one is the new partner does not bring cash for the goodwill. One is new partner brings cash for goodwill, and new partner does not bring cash for goodwill. So if he brings cash for goodwill, bank account debit to goodwill and goodwill account debit to old partner's capital account. Okay, so somebody brings money but he is not credited, so that is his contribution. If he was credited, if this man was credited, if you had passed an entry like bank account debit to see that if you give him credit, then where is his contribution? This is not contribution. No? The firm is liable to pay him. He becomes a creditor. So here the main thing that you need to observe is that money is brought, but credit is not given. So that is a charm. Money is brought, but credit is not given. That is important. Money is brought, but credit is not given. So that is to be kept in mind. That is the peculiarity of this transaction. Somebody brings money, but he is not credited. That means it is an expense for him, and it's an income for the the existing partners. So the journal entry is bank account debit to goodwill. First goodwill is credited. Goodwill account debit to old partner's capital account. Okay, you can do this entry first and do this one also. Doesn't really matter. Okay, so this should be in sacrifice ratio because the partners should be getting the credit in the order in the ratio they are foregoing. They are sacrificing their share of profits. So one who sacrifices more should get more, one who sacrifices less should get less. So that is why the importance of sacrifice ratio. Okay, so this is the case when he is bringing the cash. Now it can so happen that he doesn't bring the cash. He doesn't bring the cash, but he still bears a share of his goodwill. How does it happen? Okay, one is raise goodwill to full value, one is do not raise goodwill to full value. Okay, so if you raise the goodwill to the full value, write down goodwill account debit to old partner's capital account in the old ratio, and then immediately write it off. Immediately write it off. All partners capital account debit to goodwill, new ratio. Okay, so impact of this is the resultant impact of these two together is that the new partner gets debited and old partners gets credited. Okay, and the ratio is the sacrifice ratio. So essentially he is debited because he is supposed to bring money, but he is not bringing money, therefore debit him. Okay, and that debit is the debit that he is made is given a credit to the old partners. Okay, so that is how the old partners get benefited, and that is how he is paying. So in situation number 1, he brought cash and he was not credited, so that is his contribution. Here he does not bring cash, therefore give him a debit. His current account will be debited, or his capital account will be debited. So his contribution to the firm will be considered to that extent less. If there is interest on capital, you will get less interest on capital, isn't it? Because he is debited now. Okay, so this is how the new partner will bear a burden of his share of goodwill. Okay, so if you pass this entry, first you raise the goodwill account to the full value and credit old partner's capital account, and then write off the goodwill. Now all partners capital account debit to goodwill in the new ratio. And if you compare these two entries, what you get is the new partners debit to old partners sacrifice ratio, and what is the extent value of this figure, of this resultant figure will be the share of goodwill of the old partner, of the new partner. Okay, so the next part is do not raise goodwill to full value. Open goodwill account and adjust. Do not open goodwill account at all. It is possible that you don't open goodwill account at all also, and then still take into account the consideration of the goodwill impact. So one is you open the goodwill account only to the extent of the old partner's capital account. Okay, so goodwill account debit to old partner's capital account to the extent of share of goodwill of the new partner in the sacrifice ratio. Okay, and then you debit the new partner's capital account and credit goodwill and close it. So you are basically nothing but debiting the new partner and crediting the old partners in the sacrifice ratio. So this is the thing which, when you do not want to open the goodwill account at all, so you debit new partner's capital account and credit old partner's capital account and give it in the sacrifice ratio, and you reach the same place where you would have reached in this, or where you would have reached in this. All the effect of all the entries are same. This is the effect. Whatever you do, you are going to finally reach here. You raise goodwill and write it off. You raise goodwill to the extent of the share of the goodwill of the incoming partner, and then write it off. Or you do not raise goodwill account at all. Don't open goodwill account. Don't create a goodwill account at all. Do not write the word goodwill account anywhere. Still, you have the same impact. Whatever you do, you are ultimately going to reach this stage. New partners capital account debit to old partners capital account in the sacrifice ratio, and the amount will be what is the amount of this journal entry? Amount is equal to share of goodwill of the new partner. Share of goodwill of the new partner. So whatever you may do, you are ultimately going to land up at that stage only. So this is the goodwill scenario. Next we are going to the revaluation of assets and liabilities. Revaluation of assets and liabilities. So this is done to take a stock of the current or real position of the assets and liabilities. Because see, admission of a new partner is quite a big event in a partnership accounts, in a partnership business. Because it's something quite remarkable, it's something quite important. So when an important event happens, it may the firm may decide to take a stock of its real assets and liabilities and see that where it stands. Maybe these assets and liabilities were created over a period of time, and some of the assets may be very old. There can be some old liabilities, or so many things can happen. So since such a big event is happening, the company, the partnership firm may think of making a due diligence. The partners of the firm may think of doing a due diligence. It can do a due diligence. It will carry out a due diligence and then value the assets and liabilities of the firm. So there are valuers for this, okay, and there are valuers who can who will value the carry out the valuation of assets and liabilities. Okay. So as a result of this evaluation, this revaluation, the value of assets and liabilities will change. And revaluation account is a nominal account and results in a profit or loss. The new partner has nothing to do about the revaluation. The profit or loss on revaluation is transferred to the old partners in the old PSR. So this is important. The new partner has nothing to do with it. It is completely a property of the old partners. Okay, the new partner doesn't bother about it. Okay. What and how revalue? An asset can be revalued at a higher figure. An asset can be revalued at a lower figure. A liability can be revalued at a higher figure. A liability can be revalued at a lower figure. A new asset can be brought into records. A new liability can be brought into records. An unaccounted income can be brought into account. Unaccounted expenses can be brought into account. An additional provisioning may be required to be made for sundry debtors. An existing provision may be decided to be returned back. So these are all the situations that can happen in a revaluation. Okay. So remember, I told you that revaluation account is a nominal account. Okay. So if an asset is revalued at a higher figure, that means you are going to have profit. So your entry will be asset will be debited and revaluation will be credited. Asset debit and revaluation credit. Asset can be revalued at a lower figure. If the asset is revalued at a lower figure, then your asset value comes down. So you will make two assets, and you are going to debit revaluation account. A liability can be revalued at a higher figure. So your liability will increase. Okay. See, it can be revalued at a higher figure. So in that case, you will credit your liability. That means if you want to increase your liability, how do you do it? You credit liability and you debit revaluation. A liability can be revalued at a lower figure. That means you have to debit your liability and then you have to credit the revaluation. Okay, a new asset can be brought into records. Some asset was there which you did not take into account at all. So create a new asset, that means debit an asset, asset debit, and revaluation credit. A new liability can be brought into records, new liability. Okay, so that means you need to credit liability, revaluation is debited. An unaccounted income can be brought into account. Some income was unaccounted for. Okay, so that means what you have to do? What you have to do? This is, you have to credit revaluation and debit a accrued income. Okay, unaccounted expenses can be brought into account. So debit revaluation and credit expenses, sundry liabilities. Okay, an additional provisioning may be required to be made for sundry debtors. So you debit revaluation account and credit provision for doubtful debts. Existing provision may be decided to be written back. So debit provision and credit revaluation. So at every stage we are either debiting the revaluation account or crediting the revaluation account. When we are debiting the revaluation account, that means we are incurring a loss. When you are crediting the revaluation account, that means we are getting a profit. And the difference between the debit and the credit entries of revaluation will be resulting in a profit or loss in revaluation, which is going to be transferred to the old partner's capital account in the old PSR. If this revaluation of assets and liabilities, okay, asset value has increased, some liability value has decreased, or some new asset has come, or liability has, in certain cases, the liability value has increased. Anything can happen based on the due diligence report or the surveyors or the valuers report, and accordingly the assets and liabilities will be revalued. So at every stage of revaluation, we come across a situation where the revaluation account will be either debited or credited. Whenever we are debiting it, we are actually incurring a loss, okay, because it's a nominal account, and for nominal account the rule is debit all expenses and losses. And whenever there is a whenever we are crediting the revaluation account, because it means that we are making a profit, because revaluation account is a nominal account, and according to nominal account rule, credit all gains and income. Okay, so whenever we find that there is an income, the revaluation account is credited. Okay, and income can happen by like this: when asset goes up, it's a kind of income. When a liability goes down, it's kind of income. When a new asset comes in, it's a kind of income. When unaccounted income comes in, it's an income. Okay, it's a credit. Okay, when an existing provision is written back, it's also a kind of income. When an asset is revalued at a lower figure, so asset value comes down, therefore there is a loss. Okay, a liability can be valued at a higher figure, so that means your liability increases, therefore you incur a loss. Okay, new liability can be brought into account, so new liability is created, therefore you incur an expense or a loss. Okay, unaccounted expense, so it's again a loss, revaluation account will be debited. Okay, additional provisioning may be required, so revaluation account will be again debited, because you are creating a new expense, a new charge. The provision increases by this charge, therefore this is a loss. So this is how the revaluation account will be debited or credited for the various transactions which are going to happen based on the revaluation exercise. Okay, and in the sum it will be given to us that what is revalued at how much. Okay, sometimes they will say stock is revalued at 85%, or they can say fixed assets to be written up, okay, by 10%, or certain fixed assets to be written down by so much. So anything can be given. So based on whatever is given, you have to pass the necessary entries, and finally you have to find a balance in the revaluation account, and that revaluation balance is going to be transferred to the partner's capital account. That is what is going to happen. Okay. Next is, you see now a new partner has come. Okay. But before the partner came, this new partner came, there can be some reserves, general reserve. This is undistributed profits. Basically, these are undistributed profits. This general reserve or say profit and loss balance. So these are nothing but undistributed profit. So these are the profits which the old partners did not take, okay, and the new partner has no contribution for it. New partner did not contribute. New partner did not contribute to this. He has no role absolutely. Okay, so if that is the case, please give all the old profit lying in the form of general reserve or lying in profit loss account to the old partners in the old PSR. Okay, all such distribution to be done in the old PSR to the old partners. What is the journal entry that we will pass? We will pass general reserve debit if it is in general reserve. If it is in profit and loss account, we will debit profit and loss account debit. And we are going to credit old partners capital account. In old ratio. But only the reserves, okay, not the provisions. Provisions will be re-evaluated in the revaluation process only. If there is an increase in the provisions, then it will be routed through revaluation account. Please do not try to transfer your provision accounts to the partners capital account. So not only the benefits, if there are any fictitious assets balances reflected in the balance sheet, suppose in the balance sheet you have something like this. Something like this, deferred revenue expenditure, or say miscellaneous expenditure not written off. Okay, can be anything. Okay, losses, accumulated losses. Now, all these are debit items lying in the balance sheet, to which the new partner has no contribution. I mean, he is not responsible for this. Therefore, it is not fair to carry out this assets, these fictitious assets. So this also you should transfer. So what will be your entry? You are going to credit all this. And debit whom? Debit old partners. This is the debit balance. So if you credit it, it will close, and debit the old partners and credit all fictitious assets like this, as I told you. And losses and accumulated losses. Okay, and in the old ratio, of course. So then it will be doing proper justice to everybody. Okay. Now here then the next adjustment that we need to do is this, the capital adjustments. Essentially it means that the partners' capital needs to be in the new PSR. The partners, but this is an option, as I told you, this is an option of the partners. They have to decide about that, whether they are going to do it or not. Now if they decide that they are going to make their capital contribution according to the PSR. That means the PSR and the ratio of the partners. So for example, what I mean by it is like this. First you understand this. Say the PSR is 3:2:1. Okay, and the capital contribution was like this, the capital of A, B and C was something like this, say 40,000, okay, then this was say 30,000 and this was say 15,000. So what was the ratio over here? 40:30:15. So that means 8, 6 and 3. Okay. So the partners, but this is the profit sharing ratio. So partners may think that let us make our capital in such a way that this ratio of the capitals also becomes 3:2:1. The PSR may be decided to be, the capitals may be decided to be adjusted in such a way that the PSR and the ratio of the capital are same. Both the ratios become same. The partner's capital needs to be in the new PSR. Okay, so 3:2:1, but we see it's 8:6:3. So, so what is the situation over here? So it is like, 65,000. Okay, so if this is to be made in the ratio of say 3:2:1, so we'll make it 16,000 for calculation ease. So that means if the PSR has to be if the capital contribution has to be according to PSR, that means A's capital should be 3/6 of 66. A's capital should be then 33,000. B's capital should be 2/6 of 66. His capital should be 22,000. And C's capital, this B, and C's should be 1/6, that is 11,000. Okay. So we have already here how much? 40 A, B and C. We have 40,000. We have 30,000 and we have 16,000. In order to make this in the profit sharing ratio, the capital should be 33,000 and this should be 22,000 and his should be 11,000. I made some mistake here. I'll make this as 6,000. Okay. So that means what? A's capital is supposed to be 33. It is now 40. So pay him 7,000. B's capital is supposed to be 22. He is having 30. So pay him 8,000. C's capital is supposed to be 11. His capital is 6,000. So let him pay. You have to make this 20. So, okay. So A's capital is 40. So he has, but his capital should be 33,000. So A will get paid. A to be paid. A to be paid how much? 7,000. B's capital is supposed to be 20,000, supposed to be 22,000, but it is now 20,000. So B will need to pay 2,000. C's capital is supposed to be 6,000, but C's capital is supposed to be 11,000, but he is having only 6,000. So C to pay 5,000. So this 5,000 plus 2,000, 7,000, these two people will bring and they will pay this 7,000 rupees, and then the capital and the PSR will be the same. The ratio of the capitals and the ratio of the PSR will be the same. So this is what, this here I have mentioned that, an amount is fixed and the partner's capital account need to be adjusted. So you take the total predetermined capital proposed, calculate the proportional amount for each partner in the new PSR should be figured, see where the figures of capital after all adjustments now stand, either pay the partners or make the partners pay for credit outstanding or short credit respectively as applicable. This is the situation where capital will be adjusted in accordance with the PSR based on the figures as it stands after all adjustments. Okay, this is an amount is fixed. This is an amount fixed. So they have decided that their capital amount will be this amount is a predetermined figure. It's a predetermined figure. So they have decided the capital should be 2,40,000, and they are saying that A, B, C, and their profit sharing ratio is 3:2:1. Okay, and they have some capital amount. So this is a figure already predetermined. They are thinking of making total capital like this, and accordingly they are going to make adjustments, or they are going to make payments, new payments, or they will be paid off. But the total capital should be 2,40,000, and the ratio of capital contribution should be equal to the ratio of the profit sharing. So this is how it will be happening. But there can be other cases where the capital to be adjusted in accordance with the BSR based on the figures as it stands after all adjustments. That can also happen. So make the total of the partner's capital account as it stands. Calculate the partner's share in the new PSR. Either pay the partners or make the partners pay for credit outstanding or short credit respectively as applicable. Then this is another situation. Old partner's capital account adjusted according to the capital brought in by the new partner. Okay, so take the new partner's capital account, take the new partner's share of profit. So this will be the A into reciprocal of B will be equal to C. Then total capital will be total capital required. D will be total capital required. Okay. So reciprocal of B is equal to C, okay, and which is equal to total capital required. Okay, so this D is superfluous actually. Calculate each old partner's capital as a proportion of C, okay, and compare C with the last adjustment capital, and then you calculate. Then it can be that the new partner share is determined according to the old partner's capital. That is also possible. Okay, so similar. Now accounting implication on retirement of a partner. Pay the retiring partner his share of revaluation profit, his share of any reserve or any unabsorbed loss or fictitious asset, his share of goodwill. So again the same goodwill, similarly raise goodwill at full value, raise goodwill to the value of the share of the retiring partner, or do not raise goodwill. So if you raise goodwill at full value, goodwill account debit to all partners capital account and existing partners capital account to goodwill account. So this is the existing ratio. Okay, this is done in the existing ratio, and then when you write off, then you do it in the new ratio. Okay, so this is the thing. Okay, or raise goodwill to the value of the share of the returning partner only. Okay, so then you will do what? You will write over here You write over here goodwill account debit, to new partner to retiring partner's capital account. Okay, and then existing partners debit, existing partners capital account debit, existing partners capital account debit to goodwill. Existing partners capital account debit to goodwill, and this will be in the benefit ratio. It will be the benefit ratio. Okay, and we know what is the benefit ratio now. And then you do not raise goodwill. Fine, if you do not raise goodwill, just debit. Simply debit existing partners capital account, and you credit the retiring partner. Credit the retiring partner. Okay, and so like this will be like A and B definitely. So this will be like if this is A and B, so this will be done in the benefit ratio. Sharing will be made sharing in benefit ratio. So it's just similar to admission of a new partner, but here only thing is that retiring of the dead partner or the retiring partner account is going to get credited, and the existing partners, they have to bear it according to the benefit ratio. So whatever you do, you ultimately you come to this situation. Either you raise goodwill to the full value and then write it off against the existing partners, or you raise goodwill only to the extent of the retiring partner's share, okay, and then you write it off, or you don't open goodwill account at all and pass this entry. So whatever you do, ultimately this is the impact. For the death of a partner, it's similar to that of retirement. Okay, now before I say that, remember that even for the death of a partner, the revaluation can be made and revaluation profit will be done. Okay, and transfer to the retiring partner. Okay, if he has any reserve also, same. Goodwill we have just now discussed. So there is no difference, as far as the retirement of a partner and admission of a partner is concerned. The difference is only that the new partner doesn't get any share of profits or old profits or whatever. It's all enjoyed by the old partners. And here the retiring partner gets a share of it because he had contributed to those profits, which has now got transferred into reserves. Okay. So, and also of course goodwill. Now for death of a partner, it is exactly same to the retirement except for certain points. One is that you need to open an account called dead partners executors account. debt partners executors account. You need to open an account and you open debt partners executors account and transfer all credits and debits, if any, to the executors account. Okay, first. So example, capital account debit, general reserve debit, profit and loss reserve debit. If there is revaluation debit to executors account. And another thing you must remember that in the case of a death of a partner, the executor may be paid immediately. If it is paid immediately, then it's fine. Okay. Oh, and also he is also going to get a share of goodwill. Remember. Okay. So and the entry will be just the same. Okay. So instead of crediting the old partners, you must credit the executor's account, because there is no point in crediting the old partner's capital account because he doesn't exist anymore in this world. So what is the point in crediting his capital? So, or his capital, first of all, his capital you transfer to the executor's account, and therefore, thereafter, whatever entry you have to pass through executor's account. Now, the executor can be paid immediately or not immediately. If he is paid immediately, well and good. If he is not paid immediately, this is important. His amount unpaid will be treated amount unpaid to the executors will be treated as loan and will carry 6% interest. Amount unpaid to the executors will be treated as loan and will carry 6% interest. But the executor can also use another option. They can say that no, I don't want 6% interest. You must pay me my share of profit, my share of profit, to the extent that my capital, which you did not pay, has been used to get the profit till the date of payment. So what is meant by this is, say for example, what I mean by this is, suppose the executor's account ultimate calculation we get 1 lakh. Now, and I am not able to pay it immediately. So there are two options. One is I tell the executor, see, I will pay you with 6% interest. That 6% is the same rate of interest on capital, interest on loan as per Partnership Act. 6% rate, I will pay you at 6% rate when I pay. 6% interest. When I pay, I am going to pay 6% interest. Pay with 6%. Pay with 6% interest when I pay. If the executors agree, or pay proportionate profit earned from the date of death to the date of payment pay proportionate profit earned from the date of death to the date of payment. Okay. So how is that calculated? Say for example, the profit for this year, profit for the period concerned, is suppose calculated to be 12,000 rupees. Okay, 12,000 rupees, and the total capital A, B and executors is, say for example, this is 1 lakh, so suppose it is 3 lakhs. So A's share of profit will be A's share of profit will be 1 lakh by 3 lakhs into 12,000. So that is 1/3, so 4,000. So out of 12,000, he is going to get 4,000 because his contribution was 1/3 of the total capital contribution. That's why he is going to get 1/3. So this is how this depends on the option used by the executor. This depends on the option used by the executor. Okay. If the option used by the executor is this, then he can use this option. And at the date of the payment, this will be the way that how he will be paid. So this is basically so we have come to the end of the session. So this is what we are going to do. This is what you have learned in today's session. We saw today the various situations, and we discussed this one. We made a comprehensive discussion about partnership accounts, and we have completed it. Okay, so this is my thing. You can actually, I have already taken a course. And where the partnership account has been discussed in thorough detail. The name of the course is Crash Course on Accountancy for CA Foundation. Crash Course on Accountancy for CA Foundation. So this is what I want to. So this is already course taken over here. So if you use my referral code is this is my referral code. Okay, this is my referral code. So it is CA Kajal. My name is that, here. So these two up to here, but all in blocks. So I'll write it again. CA C CA referral code CA and if you use this code you are going to get 10% discount and also the access to the study materials of many other educators. So you can think about it, and with that we have come to the end of this session. I hope you have understood it, and I'll be meeting you again soon for discussing a different topic. So thank you very much and have a nice day all of you. Bye.